Welcome to another financial markets update for Hodges Real Estate. I'm Tom Elliott, coming to you from the studios here at radio station 3AW. Well, lots of interesting things have been occurring in the world of finance since I last spoke to you. Firstly, of course, we've had another interest rate cut courtesy of the Reserve Bank. Now, there was some debate directly after the interest rate cut as to whether it would be passed on by the big four banks to their customers. That's all of us. The good news is that every one of them, from the ANZ, NAB, Westpac and of course the Commonwealth Bank, all passed on the full 25 basis points. The sting of the tail, however, is that the banks have made it very, very clear that they can no longer continue in the future to pass on any such rate cuts that the Reserve Bank might decide to do. So make the most of this rate cut. I do think further official rate cuts are in the offing, both in February and in March, but I don't think all of them, if they do come, will be passed on by the big four banks. Since we last spoke, the share market has been extremely volatile, very large daily movements. It has declined since mid-November through to mid-December, and I do think that more money is likely to exit the share market and go into other asset classes, of which of course property is an important one. Now, the Eurozone and the crisis that's going on in there is really what is driving markets at the moment. The European Central Bank is the last big entity that could be tapped on the shoulder for money to solve Europe's problems. The problem is that the European Bank, under its constitution, the central bank, is not allowed to lend money directly to governments. It can lend money to banks in Europe, but not to governments. Now, the new head of the European Central Bank pointed out that the charter could be changed. I think that's going to happen fairly soon, within the next couple of months. In the US, things are actually more positive. US unemployment has trickled down. It was around about 9.2, 9.3% at its peak. The most latest figures suggest that it's fallen to around 8.6, 8.7%. This is obviously still very high when you compare it to here in Australia, where unemployment is in the low 5% range. However, it is moving in the right direction. I think the US economy is going to start recovering fairly soon. This is in contrast to Europe, which I think could face a decade-long recession, but I don't think that actually matters too much for Australia. So what about Australia? Well, Australia's in pretty good shape at the moment. Unemployment has stayed resolutely low. We do have what's called a two-speed economy. That is, without the mining boom, we'd have a very slow one-speed economy. But hey, the mining boom is what we've got, and we should be grateful for it. Perhaps the biggest problem we have is the fact that our currency is still very, very strong. The Australian dollar is still marginally above parity with the US dollar. This means that tourism sectors are really struggling. It also means that overseas buyers of Australian property have been a bit thin on the ground in recent months, but it does mean, of course, that a lot of consumer goods are a lot cheaper for Australian buyers, and it means we can all enjoy more holidays overseas, assuming we have some cash to do so. So what does it mean for the property market, all of this? Well, interest rate cuts are unambiguously good for property. Obviously what we need now is more confidence, whether it's consumer confidence, which has been low, property buyer confidence, investor confidence. I think these things will come as money gets cheaper. So that's what we'll be looking for in the new year, slightly cheaper money, hopefully more optimism in the stock market, hopefully more optimism in the property market. I'd like to wish you all a very Merry Christmas and a Happy New Year, and I look forward to your company again in 2012. I'm Tom Elliott, Financial Markets Report for Hodges Real Estate.